Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate jargon so you don't have to. Today, we've got a juicy financial report from Xenia Hotels and Resorts Inc., or XR if you prefer. Buckle up because this report is packed with numbers that might just tell us where their hotels are heading. And hey, if you like getting straight answers from these kinds of documents, make sure you subscribe. Also, join our Discord community, linked in the description below for more great insights. Alright, let's dive into Xenia Hotels IMAMP Resorts' latest quarterly report for the period ending the 30th of September 2025. This is a real estate investment trust or REIT focused on luxury and upper upscale hotels. Think of them as owning big fancy hotels. First up, the balance sheet. This is like a snapshot of what the company owns and what it owes at a specific moment. On the 30th of September 2025, we see total assets around $2.86 billion. That includes their properties, which are the main event. Now, when we look at liabilities, we see debt, which is pretty significant at over $1.4 billion. That means they owe quite a bit of money. Now let's look at how much money they made and spent. For the 3 months ending the 30th of September 2025, they actually reported a net loss of about $14.5 million. Ouch, that is down from a smaller loss in the same period last year. For the 9 months of the year, they did manage to report a net income of about $60.5 million. So it has its ups and downs. The key takeaway here is that while they might be profitable for the year, the most recent quarter was a bit of a rough patch. And when you divide that loss by the number of shares, things look even more sobering. For the quarter, it is a loss of $0.14 per S-share. Not great, but not the end of the world if it's temporary. Let's talk about cash flow. This tells us how much actual cash is coming in and going out. For the 9 months ending the 30th of September 2025, they generated a healthy $155 million from operations. That is a good sign. They also used a good chunk of cash for investing activities, mainly buying and selling properties and making capital improvements, which is normal for a hotel company. When it comes to financing, they spent money on repurchasing shares and paying dividends, which is generally a sign of confidence in their business. Now, about that debt, it is a big piece of the puzzle. They have various loans, including mortgage loans and corporate credit facilities. As of the 30th of September 2025, their total debt was around $1.42 billion after accounting for fees. The weighted average interest rate on this debt is about 5.63%. This is important because a significant portion of their income goes towards paying off these loans. They also use financial instruments called derivatives, specifically interest rate swaps, to manage the risk of changing interest rates on their variable rate debt. Think of it as a way to lock in a certain interest rate to avoid surprises. This section talks about how they value certain assets and liabilities. For things like their interest rate swaps, they use observable market data, which is good. It means the valuation isn't based on pure guesswork. Looking at stockholders' equity, we see that the total equity is about $1.22 billion. This includes common stock, additional paid-in capital, and retained earnings. They also conduct stock repurchase programs, meaning they buy back their own shares from the market. This can sometimes signal that management believes the stock is undervalued. This part discusses stock awards and long-term incentive plan units given to employees. This is a common way for companies to reward and retain their key people. The values here aren't small and can impact earnings. Here, they mention leases for ground, parking, and office space. They also talk about management and franchise agreements for their hotels. These are ongoing obligations that impact their finances. Xenia reports its business as one main segment, investment in hotel properties. They look at each hotel individually to make decisions. They use a measure called Hotel EBITDA, which is earnings before interest, taxes, depreciation, and amortization, to gauge how well their hotels are performing. This is a common metric in the real estate and hospitality industry. For the third quarter of 2025, Hotel EBITDA was about $46.9 million, a slight decrease from the year before. Now, for the management's take on things, they acknowledge economic challenges like inflation and rising interest rates. For the 3 months ending the 30th of September 2025, their RevPAR, which is revenue per available room, increased by 2.2%. That is a positive sign driven by higher room rates. However, for the same period, their net loss widened, mainly due to increased interest expenses and gains from property sales in the prior year. For the 9 months, they saw a net income increase, largely due to significant gains from selling properties. They track things like RevPAR, average daily rate, and occupancy. For the total portfolio, RevPAR went up about 2.2% in the third quarter, which is good. Occupancy slightly decreased, but average daily rate went up. This suggests they can command higher prices for their rooms. Looking at revenues, rooms revenue actually decreased slightly in the third quarter, but food and beverage and other revenues increased. The 9-month revenues show a more significant jump in food and beverage and other revenues. This indicates guests are spending more on dining and other services. Hotel operating expenses also went up. Rooms expenses stayed pretty flat, but food and beverage and other direct expenses saw increases. Overall hotel operating expenses rose by 0.8% for the quarter. These are expenses not directly tied to hotel operations, like depreciation, taxes, and general administrative costs. These expenses ticked up slightly. Here is where we see the gains from selling properties. For the 9 months ending the 30th of September 2025, they reported a significant gain of nearly $40 million from selling investment properties. Interest expense also went up, which is a concern given their debt load. They have about $188 million in cash and about $80 million in restricted cash. They also have access to a $500 million revolving credit facility, which is like a line of credit they can draw on if needed. They seem confident they have enough cash flow and borrowing capacity to meet their obligations. This section defines measures like EBITDA and FFO, which are used in the real estate industry to assess performance. They're trying to show a clearer picture of operational health by adjusting for things like gains from property sales and depreciation. For the third quarter, their adjusted EBITDA attributable to common stock and unit holders decreased slightly, while their adjusted FFO attributable to common stock and unit holders also saw a dip. So, what is the story here for Xenia Hotels and Resorts? On one hand, they are managing to increase revenue per room and have a good amount of cash and borrowing capacity. They also did well in selling off some properties which brought in cash and likely improved their overall portfolio. But on the other hand, a widening net loss in the most recent quarter and rising interest expenses are red flags. Their debt is substantial, and those interest payments eat into profits. They seem to be strategically selling some assets and focusing on managing costs, but the overall profitability picture for the latest quarter is a bit concerning. The increase in food and beverage and other revenues is positive, showing guests are spending more once they are at the hotels. Looking at the future, their reliance on debt is definitely something to watch. If interest rates continue to climb or if the economy slows down significantly, those interest payments could become even more burdensome. However, their strategy of focusing on luxury and upper upscale hotels in high demand markets, combined with careful management of capital and potential asset sales, could pay off. Now, for our breakdown, Xenia Hotels and Resorts Inc. is navigating a tricky economic landscape. Strengths include their prime hotel locations, increasing repair and strategic asset sales. Weaknesses are the significant debt load and the net loss reported in the recent quarter. A key opportunity lies in further optimizing their hotel portfolio and managing operational costs effectively. A significant risk remains the interest rate environment and potential economic downturns impacting travel demand. Overall, they appear to be making moves to manage their finances, but consistent profitability will be key. Alright, that's our deep dive into Xenia Hotels and Resorts' latest financial report. What do you think about their performance and strategy? Let us know in the comments below. If this analysis was helpful, smash that like button and subscribe for more corporate breakdowns. And don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.